I think it was back in July, you said inflation was going to be temporary. I think a lot of Americans are wondering what your definition of temporary is.
Well, you're being a wise guy with me a little bit, and I understand that's your job.
You know, Lester Holt, NBC, he just laid it out there. Wise guy, he's doing his job. We just had a 7.5% inflation report, and everything Mr. Biden and his team has said on inflation has been wrong. Wrong. And by the way, Yellen, the Treasury Secretary, is still out there saying the inflation rate by the end of the year is going to be 2%. She's nuts. Joining me now to talk about this is my old pal Robert Heller, who's a former Federal Reserve governor. He was appointed by Ronald Reagan. And speaking of Ronald Reagan, Art Laffer, former Reagan advisor and supply-side guru and Presidential Medal of Freedom recipient. Bob Heller, just with both of you guys, two geniuses, it's a great pleasure to have you on the show. Commodity prices. We have a picture, we have a chart. I don't know whether you can see it or not, but the CRB commodity index is soaring, absolutely soaring. And going back to your days on the Fed with Manley Johnson and Wayne Angell, you know, it seems to me the Federal Reserve has got a tightened policy with higher rates and selling bonds rather than buying them until they see those commodity indicators come down. I mean, that's one way to look at it. That's not how they're looking at it. But you tell me about that. To me, that's something they got to do.
Absolutely, Larry, and good to see you again. Commodities are always a leading indicator, and commodities react fast, just like the stock market reacts fast, financial markets react fast. While the rest of the economy, there are a lot of adjustments that take a while, wage negotiations and other contracts. It takes a while for that to come into play. But the leading indicator of all of them is the money supply. Mm-hmm. And for the last 2 years, the money supply has been soaring by 25% per year. And that has driven up commodity prices and set the whole inflation train into motion.
Well, you know, the three Reagan appointees, fascinating. Yourself, my dear friend Wayne Angell, and my other good friend Manley Johnson. I served with Manley when he was in the Treasury and I was in OMB. You were a terrific threesome on the Federal Reserve Board, and you basically guaranteed price stability and very low inflation expectations, working with Volcker. Not always agreeing, but working with Volcker. Now, Art Laffer, the current Fed, before I even get to the ridiculous nominations who are unqualified to go on the board, but just saying as is, Jay Powell, okay, Jerome Powell, and he's got his Reserve Bank. They don't talk about the money supply. They don't talk about commodity price indicators, you know, as leading indicators of their policy. And I don't think they have an action plan. Art, what do you think?
I don't think so. Let me just say, Robert and Larry, it's really fun being on with the two of you, and I apologize for my dress, but I am up here in the hills of Appalachia. And just so you know, I'm not going for best dressed next year, just for the record. But no, the way Paul Volcker and Robert and Wayne and Manley did it, the way you guys did it as a team, which was spectacular, and Alan Greenspan as well, is you made sure that the money supply didn't grow, the monetary base didn't grow too rapidly, and Paul Volcker stopped that in '79, I think, in '80, and if you look at the commodity price index, which Chuck Cadillac and I had a piece in the Wall Street Journal on Volcker's price rule, which is exactly what he did. It worked, and they let interest rates get up. I think the prime when Reagan took office, January 20th, '81, was 21.5%. These guys have not a clue what monetary policy is. They're talking about raising it maybe 1%, which means you've got a negative real rate of maybe, 6%? Yeah. That's just terrible. Makes no sense. I don't see any hope for inflation coming down substantially.
You know, Bob Heller, I was talking to our friend Kevin Hassett this morning, and he suggested something that I think is very sensible. Kevin said the Fed ought to be raising the funds rate, the Fed funds target rate, by 50 basis points each meeting until this commodity index or other market indicators start bending down. What they're going to do, maybe, is these little incremental quarter point that Arthur mentioned, which will have no impact whatsoever. What do you think about that?
I think the Federal Reserve is way behind the curve. What Hassett's saying is right. You got to get the Fed funds rate close to the inflation rate and a little bit above it in order to push inflation down again.
Yes.
It's 1:30.
Yes. Art Laffer.
He's just right. He's totally right. Robert's right.
No, I was going to say this. The headline story in the Wall Street Journal yesterday, it's a news story. Higher inflation is probably costing you $250 a month. That's $3,000 a year. This was a study done by Moody's, which surprises me because usually they roll over for the left-wing Keynesians, but this is pretty good. It's actually not Mark Zandi, my friend. It's by somebody else named Ryan Sweet. And there's a second study by one of the big banks, find it in a minute, that basically says it is the middle class that gets hurt the hardest because they do drive their cars, gasoline prices are up, grocery prices are way up. They get hit harder than the upper class, and they actually get harder than the lower incomes because the lower incomes don't own cars and drive. It's a middle class tax hike. $250 a month, $3,000 a year, which is why I say save America, kill inflation. We're going to be killing the middle class.
Yeah, you're completely right. But the rich get hurt too, Larry, and the poor get hurt. It's just that the middle class gets hurt more than the other two, and that will even out where everyone has disastrous results from this. You've got to stop this right now. Kill inflation is the right thing to do. And when it used to be called inflation is the cruelest tax of all,
yes,
it is a very, very cruel tax. And it's very tough to stop, but Robert was right. I think what they should stop doing is buying bonds. Don't buy any more. Let the ones they have roll off and let interest rates settle in where they should settle in. And my guess, you'd see the 10-year bond yield somewhere around 9%, something like that.
Right.
And that's where it should be with this type of inflation.
Got to leave it here.
Thank
Art
you, Larry.
Laffer with the deplorables. Bob Heller.